let's jump right in with an example. And what I'd like to do is the same first example that we looked at in chapter 15a. And then, you guessed it, we're going to go on and do the second example that we looked at in 15a. And we'll do them both from an enterprise value perspective instead of from just a shareholder, just an owner's perspective. All right, so let's start here. So should Max Value and its lending partner team up to purchase and refinance work closing? So now we've got the partnership of what could be the equity holders and the lenders. So they're looking at this together. And when they're doing that, they need, of course, the enterprise value. Okay, so the situation with Max Value is exactly as it was in the previous chapter. Okay, it makes the close, it's stable, steady, slower, no future growth. That's going to be great because that'll allow us to model it as a perpetuity. It's a well-managed business, and the stock of the firm, all the shares of equity of the firm, are available for sale for $100 million. Okay, and that's going to be P D plus E because there is no debt in the firm. So that's going to be the total. And then we have the operating data. They have a 40% tax rate. They have no debt. And we have their income statement exactly like it was in the previous chapter. They have no interest because they have no debt, so no interest expense. So the team wants to know, the debt and equity team, the stakeholder, the financial stakeholder team wants to know if it should purchase and restructure WCI. So i.e., what does that always come down to for us? Is it an NPV plus project, right? That's how whenever we're using discounted cash flow methods, we measure whether or not a project is good because NPV is the one DCF method that always works. So we're going to use that. Okay, so Max Value's assumptions are exactly as they were in the previous chapter. It's a well-run firm. They can't improve their operations. It's going to operate in steady state indefinitely, so they can model it as a perpetuity. They do feel like the optimum capital structure is not for this company to have no debt, but for this company to have a WD ratio of 20%. So that would be 20 million in debt and 80 million in equity. So as part of this whole deal, they're going to buy the firm and restructure the debt, exactly like they did in the last chapter. And how is that going to work? It's going to work exactly as it did in the last chapter. Okay, what's going to happen is at the time of purchase, WCI is going to take out a loan. Who are they going to take out the loan from? The lender in our lending team, right? And then once they get that 20 million, they put that in a wheelbarrow and give it to the prior owners along with the 80 million that's put in the wheelbarrow from Max Value. So again, this is called a leverage buyout. So it's just like last chapter, it's just this time we're working with and we know who is going to be giving the loan to WCI at the moment that the firm is purchased. And whoever is giving them that loan is part of our enterprise value team. Okay, so we have some return and related stuff, just like we had last time, RF, RM, RD, RE. So I've computed RD for. So this important thing for both of these is that these are going to be as restructured with that 20% leverage in both cases. So that's good. And we looked at in the last chapter how to compute RE from CAPM, so we're not going to torture ourselves with that again in this chapter. We'll say that our managing director has given us this information. A little bit of terminology that's good to know. In the world of finance, folks would say the post-purchase capitalization of the firm is going to be 100 million. And now, because that's going to include the 20, let's get that there, the 20 in debt and the 80 in equity. Now it's more meaningful to say that this is truly the market estimate of enterprise value, right? That's what the market is saying we would have to cough up to own this firm and restructure it the way that we want to restructure it. Okay, so we are working once again for a managing director at Mask Value, and she asks us to find, in this case, she wants us to find the free cash flow to everybody, assuming that it's valid to model WCI as a perpetuity. So we don't have to worry about year by year. Every year is going to be the same free cash flow if it's a perpetuity. So that's great. That makes our life simpler. The appropriate RWAC, and then let's get the present value of all future cash flows to both the shareholders and the lenders, to the enterprise value audience here. And then once we've got that, let's compute the NPV of this project, which is what the NPV always is, the present value of every stinking cash flow from this project, starting with t equals 0. So at t equals 0, we have this minus amount. We've got to cough up the loan, the team does, cough up the loan of 20 million and cough up the 80 million to buy the firm. So that's going to be negative. And then what we're going to get out of it is the present value of all those perpetuity cash flows. So another way we can say that is the NPV is equal to the present value of these cash flows to all financial stakeholders minus the total purchase price, including the equity and the loan that we're going to have to install to make this all work. Okay, so let's go ahead and help our managing director out and solve this. So the first thing we want to remember is our formula for general case free cash flows in the future with simple accounting, right? And then we're so happy. I'm so happy. This makes things so easy for us because WCI is operating in steady state forever. So that tells us a few great things. That tells us that the EBIT in every year is going to be the same. The CapEx in every year is going to be the same. The depreciation in every year is going to be the same. These, if it's a perpetuity, all these quantities remain constant forever. It also means the change in working capital every year is equal to 0. We don't need to increase our inventory, for example, because we're going to be the same size forever. And if we're in steady state, our CapEx truly should match our depreciation. Depreciation should be a good measure of the wear of our PPE, and our CapEx should match that. So we do this restructuring of 20 million loan at t equals 0, and that's it for the rest of time until hell freezes over, right? Okay, so for WCI's simple accounting steady state case, FCF D plus EI is just equal to FCF D plus E with no I, right? Okay, and that's equal to 1 minus the tax rate times EBIT. And that's what, remember, everybody in finance calls NOPAT, or net operating profit after tax. So let's see if we can compute our NOPAT, or same thing, our free cash flow that is going to be available to lenders and owners every year. So what we'll need from that is our partial income statement. We'll use just as much of the income statement as we need to get 1 minus the tax rate times EBIT. So you can see here I've grayed out existing. We don't really care about existing, right? We're going to refinance this firm at t equals 0. So I'm more interested in the as purchased, where we have this 20 million in debt. Okay, so we start out with revenue. Revenue is going to be unchanged, right, from what we saw before we bought the company. Depreciation is going to be unchanged. Other expenses are going to be unchanged. They have nothing to do with who the owner is or how much the owner paid for it or anything like that. And that's it. So we can get our EBIT subtotal from those guys. So that's 18. Then we want to take away our tax, and that's going to give us our NOPAT, right? And you might be wondering how I can do it this way when I'm really saying it's 1 minus the tax rate times EBIT. Well, that's the same thing as doing this the accounting way, taking EBIT and then subtracting the tax here, right? Because this is equal to EBIT minus the tax rate times EBIT, right? And that's EBIT minus tax on EBIT. Okay, so if we just tax them on their EBIT. That's what it would look like. So this is completely the same here. This is just a nice short way of doing this to working it out longhand, the way the accountants among us would love to do it and expect to see it. So you can do it either way. They're completely identical. Okay, so let's get the show on the road here. So we've got our EBIT is 18. Okay, we just saw how we computed that. And our 1 minus the tax rate times EBIT is going to be our 1 minus 40%. I know that's 60%, but you know I have early onset Alzheimer's, and I'm an aging WASP who just can't do math in his head, so bear with me. Okay, let's see. And that's times our 18, okay? And that's equal to, let's make sure we get the same answer that we had before, and that's 10.8, and that's what I've got down here. And I know 99.9% of you could do that in your head, but what the heck, it's good for me to do it again anyway. So that's equal to 10.8. Okay, let me keep going here a little bit. What I want to do is put what we've got here in the context of our general formula. Let's just follow that through and just see if it all makes sense. So what I've got now is this term, EBIT times 1 minus the tax rate. And I've told you, because of all the assumptions that we've made, it's a perpetuity, et cetera, that actually is the free cash flow available to everyone. So let's see how that works. Again, continuing with looking at this the way an accountant would expect to. So we'd say minus changes in working capital. We've said those are equal to 0, plus depreciation. We always want to add back depreciation to go from cash and accruals to just cash, right? That we did that, you learned about that in our indirect method cash flow statement. So we add back our depreciation of 30, and then we subtract CapEx of 30, because if it is in steady state, the CapEx will be equal to the depreciation. And this is a negative number because that's cash flying out the door to buy new equipment and maintain equipment and stuff like that. So now we can add everything up. Our NOPAT minus our changes in working capital plus our depreciation minus our CapEx is equal to our general case free cash flow to everybody, and that's 10.8, and it's the same as we have up here for NOPAT. Again, because this is a steady state firm operating in perpetuity. Okay, so next let's compute our weighted average cost of capital, our WACC for our post-purchase capitalization. So again, that's going to be 1 minus the tax rate times our RD times our WD, and that's going to be plus our RE times our WE. Okay, so this time I'll put in the 60% there times our RD 7.25%. And that's going to be times our weight of debt, and that is 20%. And that's plus our RE, I think was 12.33%. times our weight of equity is 80%. And once again, let's just throw this into Excel. Okay, so this is what it would look like if you were writing it out on a piece of paper. And then the next step is you put those numbers into your calculator, and you get 10.73%, which is what we've got down here. And now we're ready to get the NPV of this project for the whole team. NPV for lenders and owners, putative, of course, potential. All right, so we've got our general equation, right? The NPV for everyone is the purchase price for all the shares of stock and also to buy the existing debt or get a new loan if we are refinancing the firm. Plus, what's this? This is just the present value of every stinking cash flow that we expect to get from the firm for as long as we are associated with the firm or as long as it exists. So again, the NPV to everybody is going to be minus that purchase price for the debt and the equity, arranging the debt and the equity, and the enterprise value estimate from DCF. Okay, and we have our perpetuity, so our FCF is equal to our NOPAT, and to use our perpetuity formula, remember the perpetuity formula says that the present value of a perpetuity is equal to the uniform cash flow divided by the discount rate or the interest rate. So in this case, the uniform cash flow is our free cash flow, our NOPAT, and our interest rate discount rate is our weighted average cost of capital. So those are going to be equal to 10.8 divided by 10.73%. Okay, and let's see what that looks like when we compute it out. Again, exactly how you would do it yourself, writing it out on paper, putting it into the calculator, getting this number. So that's 100.65. Okay, so that's 1/2, right? That's the present value of all these cash flows we're going to get out of it. And to get the NPV, we have to subtract what we would have to pay to make that happen at t equals 0. And from the team, it really is a payment of 100, right? Because the lender is paying 20, right? That's cash flow out from them to get the loan out the door. And the owners, the stock owners, have to put out 80. So it's a total of 100. So the NPV is equal to minus 100 plus 100.65, and I can even do that one in my head. I don't need Excel for that one, and that's equal to 0.65. Okay, and that is, in most circles, is greater than 0. So this is a good project for the team. That's what the modeling says, right? Of course, in the real world, there are many more considerations.